Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And last week we had a continuation of what we had seen in the past few weeks with regards to equity markets continuing to grind higher. We did manage to reclaim that 50-day moving average that we were speaking about at the end of last week. And we are now trading just within spitting distance of our all-time highs on the S&P 500, just above 5250. And all eyes this week is going to be on the CPI print, which comes out tomorrow morning. Inflation and job numbers have been one of the primary drivers of equity market outlooks. The sell-off that we saw here back in April was due to a hotter than expected inflation print, which shifted bond market expectations for how many rate cuts we're going to get this year. At the moment, we're only expecting 2 more rate cuts at the end of March. At the time, we were expecting 3 rate cuts. So when inflation came in hotter than expected, that shifted expectations and we saw that sell off. And then as we started to get weaker GDP numbers, last week we had jobless claims that were higher than expected. There was signs that the slowdown in the overall economy seems to be taking shape, which gives the Fed more room to cut rates again. So kind of we're shifted back towards a little bit of optimism around having more rate cuts. And tomorrow's CPI print would largely either confirm that or reverse a course again with regards to expectations. So if inflation comes in hotter than expected, I would say that would be a reason why we would see the Fed hold rates for longer. Otherwise, if inflation comes in as expected or cooler than expected, that would certainly give the market the boost or confidence that we're going to get perhaps more than 2 rate cuts this year. So that's really kind of what's driving the markets right now. And this is kind of a binary event on the back of economic data that's coming out tomorrow morning. So we'll just have to be patient and wait to see where that data comes in and how that's going to affect our overall outlook. The NASDAQ 100 just shy of that 450 all-time high. Momentum not as strong here. Relative performance on the NASDAQ 100 underperforming the S&P 500. And as you can see, momentum is stalling a little bit here. But that really, in my opinion, doesn't mean anything or doesn't shape my outlook. It really comes down to the economics number tomorrow that's going to shape that. IWM, a fair cry from the all-time highs around that 212 and a half. We're trading at around 205 right now for small caps. So small caps underperforming the S&P 500 over the last month or so. And then if you look at RSP, which is the equal weight S&P 500 index, also not quite near the all-time highs like we've seen in the market cap indices. So participation in the rally over the past 3 or 4 weeks have not really been there, which arguably is not a very strong case for markets to break out to new all-time highs and continue higher here. If you look at the fact that small caps have lagged behind, the equal weight market indices have lagged behind. These are some of the things that we have to pay attention to. And then if we look at growth versus value over the past year or so, growth has outperformed value. But over the past, 3 months or so, we've really seen value outperform growth. And that trend has continued over the past week or so. So it really is a market right now that is more consolidating and kind of playing a little bit of catch up, which generally speaking is healthy. But like I said, I think at the moment, none of that matters too much. It really comes down to, where inflation comes in. If you look at commodities, we've seen the pullback here in commodities over the past month or so. As you can see, GSG, the ETF, continues to hug the 50-day moving average, fails to break out above it. Moving average slope is starting to turn negative here. This is at risk of starting to see some further pullbacks here in commodities overall. Gold, oil, all fall into this category where rebounds in some of those commodities may be somewhat limited from that perspective. High yield bonds. Last week we talked about the fact that high yield bonds broke out to a new 52-week high. But as you can see, since it broke out to that new 52-week high, it has failed to continue higher and has kind of traded back into the trading range. So, what looked like a strong risk on buy signal coming from the bond markets have simply reversed and fizzled out from there. So we're kind of back into a much more neutral tone that the bond markets are providing, which largely aligns with the price action we've seen from equities over the past month or so, which is predominantly chop trading sideways rather than a strong, clear direction in one direction or the other. And then if you look at VIX here, we saw that jump here in VIX here up to that 13.5 level. We talked about the fact that the VIX went from 12.5 to 21.5 back to 12.5 in the span of about a month and a half. And what looked like, on this move down to 12.5 was a level of complacency that the markets hasn't seen in quite some time. We're really talking about some of the lowest levels we've seen over the past year. 12.5, we've only traded at those levels a few times throughout the year, and each time we traded it was an opportunity to be long volatility, and yesterday was no exception to that rule. Basically, we saw a bit of pickup in terms of vol over the expectations for volatility over the next 30 days. I do think that for investors who are concerned about a hotter than expected inflation print, these low vol opportunities provide a relatively inexpensive time to buy some put protection, on, let's say, SPY or SPX. We've seen an uptick obviously from yesterday, but we're still on the lower end of the trading range with regards to expectations for volatility over the next 30 days. But at the moment, traders aren't particularly concerned, even though we got that spike yesterday. But that also presents an opportunity, right? Markets aren't being complacent. Markets are basically saying they don't expect the inflation print to come in hotter than expected, which is why we see such muted volatility. But, if you feel that that's an incorrect assumption, it's an opportunity to be long vol by buying some put protection on SPY. Looking at the 10-year yield, we kind of continue to moderate around that 4.5% level on the 10-year. As you can see, it seems to have kind of found a little bit of support around this 4.45 level. Is the inflation print going to come in hotter than expected and we see 10-year yields rise tomorrow? That very well could be the case if we do see hotter than expected inflation prints. Otherwise, I would expect to see yields continue to tumble like we've seen here over the past couple of weeks back into that 4.2 level to the downside on the 10-year yield. Like I said, this comes down to a fairly binary event on the inflation print. TLT, 10-year, longer term bonds continues to hold below this $91 resistance level. As you can see, holding right now around 90.35. This support level now acts as resistance. If we have a hotter than expected inflation print, we will likely get that sell-off here in bonds, and for the risk reward to be favorable for shorts on bonds right now going into the announcement next week. I'm sorry, the announcement tomorrow. The dollar index so far has held this 105 support level. My hunch is that this is likely going to rise back into this 106.5, 107 range, and potentially retest 107 as well to the upside, which is the 52-week high on the dollar index. If we get hotter than expected inflation print, we're going to get higher yields, and that's likely going to be a tailwind for the US dollar to rise back towards that 107 level at the moment. Looking at gold, we talked a couple of weeks ago with regards to the pullback here to that 2280 level as a potential buying opportunity. But looking at how commodities overall are performing, my expectation is that, we're not likely going to get a lot more higher here in terms of gold. We're more likely to get kind of more sideways chop and potentially break below 22.80. We'll see. We're not quite there yet to make that call, but at least in the short run, I don't necessarily believe that gold is going to make a substantially higher move from here and revisit that all-time high at 24.50. We just simply are not seeing that same demand here from gold buying. On the other hand, oil, that breakdown here down to, we talked about this double top here at 88. We talked about that as a temporary top. We've now pulled all the way back to 78, which is a pretty major support level that I do think is constructive for oil to potentially start recovering a little bit from these levels. So whether you're exposed to oil through energy stocks or the oil ETF like USO, I do think that we have reached a bit of a temporary bottom here, and potentially the risk reward is more favorable for a long exposure going forward in the next few trading weeks for oil. And then looking at the individual sectors. So some of the sectors that I think are worth paying attention to right now, technology is certainly one that I think is worth paying attention to, because technology has continued to underperform the S&P 500 by about 6-7% over the last 4 or 5 months or so. So, what has been a strong leader in terms of performance, right? If you look at kind of from May of last year to the beginning of 2024, this is a sector that outperformed the S&P 500 by 15%, and it's given back nearly half of that here in the last 6 months or so. So what was a strong outperformer, if you are in the camp that you think equities can break out to new all-time highs and continue from here, you really need to see leading sectors like technology get back into that leading position. And it's just not there, at least yet. Maybe it gets there in the next few weeks, but right now it's just not there. From my perspective, if you look at the sectors that are performing, consumer discretionary, underperforming. What sectors are performing? You have communications that's doing okay, financials that's doing that's quite strong here. As you can see, financials from the October lows is outperforming the S&P 500 by about 5%. This is certainly a much more defensive sector at the moment. So the fact that you have more defensive sectors that are outperforming, not a particularly strong result, right? You recently also have seen consumer staples make a new 52-week high, outperforming the S&P 500 over the past few months. So this is a sector that has underperformed the S&P 500 by nearly 20% over the last year, but over the past few weeks, it's kind of outperformed the S&P 500 by a few percentage points. A defensive sector outperforming in this type of environment doesn't really speak to a very strong risk-on environment right now. If you look at healthcare underperforming, look at materials starting to underperform, meaning it's not kind of providing that leadership. Industrials had outperformed, but has over the past few weeks have really started to moderate that outperformance. Real estate underperforming. Real estate, one of the few sectors, has not regained the 50-day moving average, still trading below that. So far acting as resistance, potentially lower on real estate. Looking at energy hugging that 50-day moving average, failing to, so far providing as support, but looks like it could potentially break lower from here. Perhaps a bit of a temporary bounce here on oil could provide energy, the lift here off that 50-day moving average, but the relative performance is really starting to come off here in energy shares. And then look at utilities. This is the one sector that is outperforming the S&P 500 by a pretty significant margin over the past 2 months. The utility sector has outperformed the S&P 500 by 10%. A very defensive sector outperforming the S&P 500. That's not the type of sectors that you typically see outperform when markets make new all-time highs. So from my perspective, that the overall picture when we look at these sectors doesn't provide a lot of confidence to the market rally here right now. Home builders trading mostly sideways here, not really outperforming or underperforming the overall markets. And then semiconductors underperforming the S&P 500 over the past 2.5 months. What should be the sector that's leading this charge, as if you think about the AI boom, you think about the CHIPS Act and just all the money that's flowing into this particular sector and investment into this particular sector, it's not outperforming the S&P 500. There's something where the market internals and the underlying numbers just don't quite add up to, a market that's ready to break out to new all-time highs. But like I said, a lot of that can be reversed if inflation comes in cooler than expected and expectations are we get more rate cuts. We could start to see semiconductors start outperforming, technology start outperforming, consumer discretionary outperforming. So a lot of things can change tomorrow, but the way things stand today doesn't give me a ton of confidence that we're back to kind of all-time highs in equities. So with that, kind of looking at some specific names, kind of looking at this a few different ways. Let's first look at a few counter trend ideas. Now, I looked at some trend following ideas. We weren't able to find a whole lot, so I want to look at some counter trend ideas. Costco. Costco recently made a new all-time high, higher high in terms of price. But one of the things that you want to point out here is that it did not outperform the S&P 500 as it made a new high, and momentum did not confirm those new highs. So what you have here is some signs of exhaustion that Costco is likely reaching a temporary top. And with these counter trend ideas, what we're trying to do is capture a shift from a bullish to bearish trend at the very earliest possible stage. What we're basically trying to identify is the shift in trend at the time that the trend change actually happens, not waiting for a confirmation of that trend change to happen, not waiting for it to break below, a certain moving average. What we're trying to do is get in at the earliest possible point. And in order to do that, you have to align both technicals and fundamentals. Costco trades at 45 times forward earnings. This is a stock that's expected to grow EPS next year by about 10%. So you factor that into the your thought process. This is a stock that's meant to grow roughly at the same rate as your average S&P 500 stock, but trades at more than double the valuation of the average S&P 500 stock. And then you consider on top of that, this is the type of stock that has very, very thin margins. A lot of these retailers operate on extremely thin margins. You look at supermarket stocks, their margins are 2-3%. Costco is no different. It operates on about 2.5% net margin. So for every $1 they make in revenue, they only make about 2 cents in profits. So when you factor all those things together, this is starting to look like what looks like a top to me on a name like Costco. The next one I want to take a look at here is Pinterest. Similar type outlook in terms of charts for Costco, right? Higher high in terms of price. But as you can see, the relative performance is not there. So even though it made a new higher high on an absolute basis, the relative basis did not manage to make a new high. The momentum did confirm a new high here, but this is really where, if you look at the fundamentals for Pinterest, trades at 28 times forward earnings, it is expected to grow fast, right? These are the types of stocks that do show 20-25% EPS growth, but they also operate on extremely thin margins. For every $1 they make in revenue, they only make about 4 cents in profits. So when you make very thin margins, or we don't really turn a profit, yes, you're expected to grow very fast, but 28 times forward earnings is still pretty high multiple to be paying on a stock that really doesn't earn a lot in terms of profits. So another one that I think is worth paying attention to as a potential reversal lower here. And then lastly, looking at Wells Fargo. Financials have been strong here, but Wells Fargo showing some classic signs of exhaustion. Higher high in price, no longer being confirmed by higher highs in momentum. And this recent push higher here in terms of higher high in price showed that the relative performance is not there. So further signs that not everything is well on a stock like this that's pushing to new all-time highs. Wells Fargo is trading at about 12 times forward earnings, but it's not expected to grow. EPS growth is expecting to be flat over the next few years. And from my perspective, when you don't expect to grow, it's hard to justify a stock price that's, nearly doubled in the last 6 months. So classic signs of technical exhaustion, meaning buyers are exhausted. There's no fewer and fewer new buyers stepping in, and the fundamentals start to look weaker here in this current market condition that we are in at the moment. Looking at some stocks that are outperforming or underperforming, Salesforce. If you look at a 5-year chart here for Salesforce, we basically made a new 52-week, new all-time high back here in February. The all-time highs prior to that was 310. So as soon as it made a new all-time high, it immediately failed at those new all-time highs and traded back into that trading range. So it traded within this range between 295 and 310, traded in that range for about a month and a half before it broke down. And since it broke down from that trading range, it's been trading in a new range between 280 and call it 260, call it 270, very narrow range, $10 range that it's been trading in. But as it trades in this narrow range, what you see here is that the relative performance is actually starting to underperform, right? So even though it looks like it's trading sideways in a range, it's falling behind on the rest of the markets. And that really is the sign that this could be the type of stock that's starting to reverse lower. Salesforce trades at 28 times forward earnings, only expecting to grow EPS by about 16%. I know 16% sounds relatively high, and it is compared to the S&P 500. But if you think about the technology sector that it belongs in and where the stock used to grow at about 45% EPS growth per year, now we're about a third of that, 15% EPS growth. And margins aren't that high for a software company, 11% margin, net margin. So for every $1 they make in revenue, they make about 11 cents in terms of profits at the end of the day. So margins that are not that high, growth rates that are slowing down substantially, trading at certainly the higher end of valuations, 28 times forward earnings is 40% higher valuation than the average S&P 500 stock. And when you just see the technicals where it's underperforming, it's trading in that range, it looks like it's at risk of breaking lower from here. So this is the type of stock where the underperformance is starting to show up, in the relative charts that hasn't shown up in the absolute charts yet. And that's really kind of the sign that we could start to break lower from here for Salesforce. And then lastly, I'll leave you with one bullish opportunity. We don't see a lot of them at the moment, but Hershey's, multi-year decline, multi-year underperformance, and then started over, towards the end of last year, forming this massive bottoming formation. It's been trading in this range between, call it $200 and 180 or so for the better part of a year. So it started back here in October, and basically just a couple of days ago started to break out here. And even it's just yesterday, they even surpassed this 207 level, which was the kind of the recent highs in this trading range. So we broke out from here. As you can see, the relative performance is looking strong here. Momentum turned positive. It confirmed that move to the upside. This could be the start of what could be a larger move here to the upside for Hershey's. Hershey's trades at 21 times forward earnings, but it does have fairly significant margins, 18% net margins for a confectionery company, relatively high. EPS growth is not particularly phenomenal. We're looking at about 2% EPS growth, but this is really where I think the turnaround story for Hershey's may be in place, where analysts haven't caught on just yet, but we're seeing some early signs of interest here from Hershey. So I think worth paying attention to here right now, given the fundamentals look fairly strong. And we look like we're on the very early innings of a outperforming stock with Hershey's. So with that covers what I wanted to share with you here today. Hopefully this gives you an overview of kind of how we're viewing the macro environment. And honestly, it really comes down to the CPI print tomorrow. Well, we have retail sales and CPI print tomorrow. Both of them, I think, are equally important. That's going to help establish our overall macro outlook. And then hopefully I provided you with some ideas going into today's trading session. So with that, thank you so much. I hope you guys have a great trading day. And I'll see you guys here next week, where we will update you on how the CPI print came out and what our shifts, if any, in our overall outlook as a result of that would be. Thank you so much. Have a great trading day.